Welcome back to Unfair Housing. I'm Morgan Cardinal, and with me today is Chris Cloth. As a reminder, the podcast is meant to educate our listeners on what shaped our neighborhoods and our social perspectives, so we can be better guided in our efforts to improve our future and avoid repeating the mistakes of our past. We have 3 previous episodes, as well as a prologue episode for those interested in a deeper discussion on how we got to today's topic. We encourage you all to take time to go back to listen to them if you haven't already. Today, we are continuing our discussion on the building of suburbia as we know it following the Civil War. We will focus on redlining, a lending practice that helped shape segregation in housing, not only when it was first implemented, but today as well. So let's get into it. When we think of redlining, we often think of many different exclusionary practices conducted in the housing industry during the Jim Crow era to keep minorities out of white communities. But what is redlining really? Redlining was the federally sanctioned practice of color-coding maps based on the loan worthiness or risk of lending in a particular neighborhood. As I'm sure you can guess by now, often the areas considered unworthy of or too risky to loan money to happen to also be predominantly Black neighborhoods and therefore designated red. This process became known as redlining, a phrase coined during the civil rights movement with one goal: make it as difficult, if not impossible, for people in lower-ranked minority neighborhoods to access loans and become homeowners. So how did this practice begin, and why did the federal government support it? Recall from episode 2, the 1920s remained a time of economic prosperity in the U.S., in part due to the rise of the Second Industrial Revolution. Americans moved into urban areas near their jobs, which also happened to create some mixed-race neighborhoods. Home buyers and lenders entered into mortgage loans with confidence, as history to this point had shown that land and home values would increase over time. Oftentimes, these loans were paid in installments over what we would now consider to be very short durations, like 3 to 5 years. Because it was almost a guarantee the home would increase in value, most lenders freely agreed to extend the mortgages for a longer period of time as needed. This process of making loans and then extending the terms of the loans with relative ease remained common practice until the stock market crashed in 1929, and Americans began to struggle due to the economic downturn. During the Great Depression, many Americans defaulted on their mortgages due to extensive unemployment, reduction in income for those who were fortunate to remain in work, and other debt obligations that were increasingly difficult to keep up with. This led to more than 275,000 homes and 200,000 farms across the United States being foreclosed upon by lenders. In response, a series of federal home loan banks were established, largely on the same principles as the mortgage industry was originally created. The federal home loan banks, overseen by the Federal Home Loan Bank Board, gave aid only where the risk was minimal and no emergency loans were offered. This remedy offered little relief as millions of people faced foreclosure. On April 13, 1933, FDR sent letters to Congress urging them to pass legislation that would protect small homeowners, those with $10,000 in loans or less, from foreclosure to relieve homeowners from the excessive loan payments tied to mortgages taken out when the economy was stronger and home values were higher, and to declare a national policy to protect homeownership. Several months later, and after much debate, Congress passed the Homeowners Loan Act, directing the Federal Home Loan Bank Board to establish the Homeowners Loan Corporation, or HOLC, in June 1933. HOLC, as we've discussed before, was responsible for the creation of neighborhood maps, which redlined certain neighborhoods. The maps coded lower-income neighborhoods red, which were made up primarily of Black Americans, and deemed them too high of a risk for mortgages. Other neighborhoods, namely white neighborhoods with more money, were coded green, deeming them a prime location for mortgages. This practice had a lasting impact on the ability of Black Americans to build generational wealth and severely perpetuated housing segregation. To understand this process, we'll look at the history of the HOLC, consider the role of banks in the practice of redlining, and look at the lasting effects of redlining on housing practices today. Chris, tell us more about the Homeowners Loan Corporation.
Sure, Morgan. The Homeowners Loan Corporation, HOLC for short, would allow a lender to apply for HOLC financing, and if approved, HOLC would then use government bonds to buy the distressed loans from the lenders. HOLC typically accepted distressed loans they believed a prospective borrower would be able to pay back with a lower mortgage rate. Once HOLC offered to purchase and the loan was accepted by the mortgage holder, HOLC would refinance the loan at a lower rate for the borrower. Therefore, HOLC loans ultimately replaced private market loans. Within 2 years of its creation, 1.9 million people applied for HOLC mortgage assistance. HOLC issued roughly 1 million new mortgages to homeowners and bought roughly 1 in every 5 already issued mortgages. HOLC sought to improve and standardize the appraisal process used to evaluate properties with loans that applied for HOLC financing. Part of this effort to standardize this process came from the congressional debate when passing the Federal Home Loan Act, which raised this question: how do you determine the value of a home during such an economic crisis that has resulted in the decreased value of all property? So HOLC helped mortgage issuers determine how to place a monetary value on residential neighborhoods by sending out investigators. The investigators looked at things like the condition of the home itself, the condition of homes in the surrounding areas, as well as the ethnic makeup of residents in the area. The information gathered by these investigators was what HOLC used to create its color-coded maps. In addition to color coding, the maps included a neighborhood ranking from A to D, which was assigned along with a color to reflect a neighborhood's riskiness, with A being described as a minimal risk for banks and colored green, while D was considered what HOLC termed as a hazardous and high risk and assigned the color red. What did HOLC mean by high risk? Well, they were essentially looking at whether or not there would be a return on the investment made by purchasing and refinancing the existing home loan. At this time, the general opinion was a lender would lose money in black or mixed-race neighborhoods because these neighborhoods had a lower homeownership rate, homes were poorly maintained, vandalism was common, and residents had an unstable stream of income. There was no evidence that this was true for all black and mixed-race neighborhoods, but the assumption was used to label these neighborhoods as D and/or red regardless. These D-ranked neighborhoods also had, as HOLC described it, an undesirable population or an infiltration of such a population, which included Jews, Hungarians, Mexicans, and Black Americans. Due to these factors, lenders were advised to refuse to make loans or only give loans in a conservative manner, prioritizing the lender's investment over protection of the homeowner. Unfortunately, these same assumptions are still common in determining home values today. As a result, homes in redlined areas did not appreciate in value at the same rate as those in areas deemed green and desirable because the same investment of mortgage money was not extended in those areas. And again, not necessarily based on the actual condition or financial strength of the residents, but simply based on assumptions due to the demographic makeup of a neighborhood. This practice has continued to increase the wealth gap between Black and white Americans. A local example of redlining can be found in a 1936 map of the city of Orlando, which labeled 66% of the city as residential, 4% as business, and the last 30% of the city as the colored section and cheaper area. That 30%, while home to minority families, was not considered a residential area. So white families wanting to buy a home were directed toward the residential area, while minority families were forced to buy and live in the cheaper, so-called non-residential area of Orlando. But where did these theories of increased risk in Black neighborhoods even develop? Well, throughout history, skin color and race were viewed as indicators of intelligence, competence, and societal status, which played a role in redlining. The decisions by HOLC and later by the Federal Housing Administration, which created redlining, can be traced back to Richard Ely, who had the same view of Black homeowners and Black neighborhoods. A prominent academic, Ely founded the Institute for Research in Land Economics and Public Utilities in Wisconsin in 1920, later moving to Chicago. There, not only did he teach future leading economists and social scientists about real estate economics, but he also helped them get into positions within large housing and real estate organizations. While teaching economics, Ely's personal views on race were shared with his pupils. Ely, like many other academics at the time, believed Black Americans were the most inferior race, while he considered whites the most enlightened and superior race. While he did say Black Americans should be able to own property, he believed that this privilege should be earned on a case-by-case basis, while for white Americans it was a right for all. During the Great Depression, Ely's institute closed. His students found jobs in different organizations across the United States, many of them in governmental organizations like the FHA and HOLC. One former student, John H. Fahey, oversaw HOLC's mapping program. Another became the chief of underwriting at the FHA and helped write their underwriting manuals. Ely's former students shared information with each other and helped advise and support legislation and policies that would implement Ely's views on Black homeownership. Ely told colleagues that his real estate, economic, and land value theories would be felt by people 100 years later. Unfortunately, it seems that Ely was right about his legacy. In 2020, the homeownership rate for white Americans was 72.1%, but only 43.4% for Black Americans. And the median wealth of Black households is around $24,000 compared to around $189,000 for white households. HOLC existed from 1933 until 1954. Over its lifetime, HOLC lent Americans over $3.5 billion, which today is roughly $41 billion after adjusting for inflation. Before wrapping up HOLC, President Truman described its effects as successful in helping hundreds of thousands of families to maintain themselves as self-reliant homeowners, secure in their hard-earned property, and free of the threat of eviction through no fault of their own. President Truman also explained that Americans should all be proud of this demonstration of bold and constructive government action for the good of the whole country. This description of HOLC fails to acknowledge that the program was responsible for much of the economic and racial inequality that we see in homeownership in America today. We'll take a quick break in our discussion here, and when we return, Morgan will introduce you to the National Housing Act, which was passed in 1934 and fostered homeownership, at least for white homebuyers.
Hey there, Alicia here. If you or someone you know is experiencing housing discrimination, or if you would like to schedule a fair housing training, contact our Fair Housing Unit at 800-875-8785. That's 800-875-8785. To see if you qualify for other legal assistance, contact the CLS helpline at 800-405-1417. That's 800-405-1417. And don't forget, give us a like and a follow, and please share the series with your friends and family. Also be sure to follow CLS on Instagram, Facebook, and X.
Welcome back. As the major stabilizing effects of the HOLC began to take hold and the Great Depression began to subside for some Americans, the National Housing Act was passed in 1934 in an effort to release credit held by the private banking industry and further stimulate economic recovery. The National Housing Act became a cornerstone of the New Deal programs created to promote homeownership and regulate the real estate market. The private banking industry was reluctant to issue credit after the fallout of the stock market crash. To protect lender investments and encourage home loans, the Federal Housing Administration was established as part of the National Housing Act in 1934 to implement a mortgage insurance program that would cover 80% of the cost of a new home purchase. The loans were required to have repayment terms of at least 4 years and not more than 20 years, and allowed borrowers the opportunity to gain equity while the home was mortgaged. The FHA relied on the color-coded maps HOLC created to help determine which loans would be considered a safe investment and thus insured by FHA. In order to consistently evaluate loans for eligibility for insurance, the FHA created an underwriting manual. The FHA underwriting manual required restrictive covenants to be in place to prevent adverse influence or undesirable encroachment from inharmonious racial groups into a neighborhood. As we learned in episode 1, the Supreme Court ruled racial zoning practices were illegal in 1917. As a result, communities relied on restrictive covenants to achieve the same goal of segregation. As a reminder, restrictive covenants are agreements between private parties that impact the use of the land and could still be used to keep minorities from buying or renting a home. Restrictive covenants were legal until struck down by the Supreme Court in 1948. This language in the FHA underwriting manual meant loans would only be accepted for FHA insurance if the property covered by the loan included restrictions on integration with minorities. The manual explicitly stated, if a neighborhood is to retain stability, it is necessary that property shall continue to be occupied by the same social and racial classes, and that a change in social or racial occupancy generally leads to instability and a reduction in value. The FHA manual further explained that an insurable loan must not cover a location near minority neighborhoods to avoid the threat of probable infiltration of inharmonious racial groups. This theory was due to baseless fears the Great Depression would occur again, resulting in a decline in housing prices if, as the manual put it, minorities invaded the racially harmonious neighborhoods. Finally, the manual stated even schools should reflect the community and not include large numbers of children of inharmonious racial groups. In 1941, the language in the FHA manual was tested by a real estate agent in Fanwood, New Jersey, a town located in Union County. The real estate agent tried to sell homes in a new 12-unit development to Black homebuyers. The buyers were middle class with solid credit. Despite lining up a bank that was willing to lend to the Black buyers, the deals fell apart because the FHA refused to provide insurance for the loans, stating, "No loans will be given to colored developments." A second bank agreed the buyers were creditworthy, but also would not proceed without FHA backing. Today, the area remains predominantly white, despite there being an above-average percentage of Black Americans residing in the county. About 17 years later in Berkeley, California, Gerald Cohn, a white school teacher, purchased a home in a white neighborhood and received an FHA-insured mortgage. He intended to move into the home eventually, but not yet. In the meantime, he rented the home to Alfred Simmons, who was also a teacher and a Black man. The local sheriff's office contacted the FBI to investigate how Alfred became a resident in the white neighborhood. The FBI found no evidence of fraud, but still referred the case to the U.S. Attorney. Finding no violation of the law, they did not prosecute. This was not the end of the story, though. Dissatisfied, the FHA banned Gerald Cohn from ever receiving another FHA-insured loan. That's right, he was blacklisted from the FHA for renting his home to a Black man. As we've discussed, the federal government implemented segregation requirements in its New Deal housing recovery programs. But shortly thereafter, the private market, seeing an opportunity to profit, began to follow suit. Though HOLC's maps and the FHA underwriting manual were not shared with private lenders, the private lending market still began to follow the federal government's lead for risk aversion when giving mortgage loans. Private lenders often denied loans to those in neighborhoods determined to be risky, even without evidence that the property value would go down or residents of those areas would default on their loans. The private lenders likely made these decisions for the same reasons HOLC did, to ensure as much profit as possible from the loans they took possession of. In some instances, the FHA's explicit discrimination went from words in their underwriting manual and restrictive covenants to physical barriers put in place. In the 1930s, Detroit was a major city and economic hub of the country. As the population began to grow within the city, many decided to move away from the city's downtown and into nearby suburban areas. As more and more people moved, neighborhoods began to change in both size and racial makeup. Neither the Black nor white neighborhoods could obtain FHA loans due to the proximity of inharmonious racial groups. For instance, a local developer wanted to build a new whites-only neighborhood. As a condition to receive FHA-backed financing, the FHA required the developer to include a 6-foot-tall concrete wall around the development, so Black Americans would be unable to access the neighborhood. This requirement was memorialized in the FHA manual for use across the country. Specifically, the manual stated, naturally or artificially established barriers will prove effective in protecting a neighborhood and the location within it from adverse influences, including the prevention of infiltration of business and industrial use, lower class occupancy, and inharmonious racial groups. The FHA similarly supported the use of highways and railroads to physically separate neighborhoods by race. While HOLC and the FHA were explicitly furthering racial segregation through discriminatory maps and manuals, other federal agencies supported segregation efforts as well. One of those agencies was the Veterans Administration. The history of the Veterans Administration, also known as the VA, can be traced back to the 1600s. But the early beginnings of the VA we know today began when the U.S. entered World War I. Congress created a series of veterans benefits programs in 1917. Following World War I, VA benefits were administered across 3 different administrative agencies. This created a confusing system of inefficient support for our country's heroes. So in 1930, the FDR administration began consolidating these agencies to administer pensions and programs for returning soldiers. In the 1940s, soldiers began returning to America from World War II. The federal government, fresh off of overcoming the Great Depression, was worried the influx of young men into the labor force would lead to more economic instability. They wanted to help provide long-term benefits to veterans, especially those who were poor, and get them readjusted to life outside the military. To help provide for these soldiers who fought for their country, Congress passed bipartisan legislation enacting the Servicemen's Readjustment Act of 1944, also known as the GI Bill, which provided veterans with funding for education, unemployment benefits, assistance finding jobs, and government backing on home loans. Instead of directly providing soldiers with loans themselves, the VA backed veterans' mortgages, guaranteeing the federal government would pay back 50% of the loan up to $2,000, which was later increased to $4,000 if the borrower defaulted. When determining which mortgages to back, the VA used the FHA's underwriting manual. 16 million Americans fought for their country during World War II. So their return was a joyous occasion as Americans wanted to support the men and women who fought for the country. On the other hand, for the 1.6 million soldiers who were Black, there was very little love or support. Instead of being treated like heroes, they had to go back to segregation, discrimination, and violence. Isaac Woodard is an example of this treatment. Woodard took a Greyhound bus from Georgia to South Carolina, returning home following the war. During the trip, Woodard asked the white bus driver to stop the bus for a bathroom break. The white bus driver refused to stop, instead cursing at Woodard. Woodard confronted the bus driver by asking the bus driver not to speak to him like that, stating, "I am a man just like you." At the next stop in South Carolina, Woodard was taken off the bus by a local police chief, Linwood Shull. Woodard was arrested and beaten so severely that he was permanently blinded, all while wearing his military dress uniform. For those Black Americans who were fortunate to escape physical attacks, there was still an uphill battle to receive their GI benefits. Southern politicians were afraid Americans would sympathize with Black veterans and wanted to ensure Jim Crow laws remained in place. To make sure that happened, the U.S. representative from Mississippi, John Rankin, who opposed interracial marriage and desegregation, insisted GI Bill benefits be overseen by individual states and not the federal government. He went so far as to withhold a proxy vote on the GI Bill because it proposed to give both Black and white veterans $1,040 in unemployment benefits. Eventually, after much debate, the bill passed with the unemployment benefits included. But Rankin still got his way, with the GI Bill's benefits being overseen by the states. Because of this, states were able to hinder and even stop Black veterans in their attempt to use their VA benefits. In fact, only 2 out of almost 3,500 home loan applications from Black borrowers in Mississippi and 100 out of almost 67,000 applications in New York and New Jersey were granted. On the off chance a Black veteran was able to secure a loan, they had to deal with many other challenges due to their race. Eugene Burnett, a Black soldier returning from World War II, wanted to move to Levittown, New York to start his family. He saw an advertisement and decided to tour home with his soon-to-be wife. When he asked the salesman about purchasing a home, he was told Alfred Levitt hadn't decided if he wanted to sell homes to Black Americans yet, which of course wasn't true because Black families were prohibited from moving to Levittown from the start. Burnett had to then move to nearby Roanoke Park. Today, home prices in Amityville, where Roanoke Park is located, are still valued less than those of Levittown. This means the increased wealth from the appreciation of home values in Levittown was not afforded to veteran Eugene Burnett and his family. Even if a Black veteran was able to realize the benefits afforded under the GI Bill, they would often be met with threats and violence from neighbors, rather than being respected as heroes who fought for their country. And as you may recall from episode 3, Navy veteran Wilbur Gary was able to purchase a home in a white suburb in Rollingwood, California, and is an example of a World War II veteran who was able to use the GI Bill. While Gary was successful in his home purchase, he and his family were unable to equally enjoy their homeownership rights, instead facing threats and vandalism. Because Black Americans were so commonly turned away from the traditional lending market, many Black Americans had to use other exploitative lending forms to purchase a home, such as contract buying, which we will discuss in more depth in a future episode. For now, I'll just say that contract buying was a method used to deny homeowners full ownership of their property and deprive them of wealth. Almost like a layaway program, where home buyers would pay for the home in monthly installments while not having full ownership of the home until the last payment was made. In the off chance Black Americans were able to get a mortgage, the mortgage was generally predatory, with unfair, often abusive terms, such as significantly higher interest rates.
Redlining not only has historical relevance, but we still see its effects on minority communities today. According to a 2018 study from the National Community Reinvestment Coalition, 72% of 1930s A-graded neighborhoods are considered middle to upper income neighborhoods today, and most are still non-Hispanic white. On the other hand, neighborhoods previously categorized as D are split between low to moderate income and middle to upper income and are still considered majority minority. Today, when comparing cities that had a higher percentage of HOLC graded desirable neighborhoods versus those that HOLC graded high-risk areas, there is presently a high level of economic inequality between the two. This shows that redlining helped create racial economic inequality that still endures today. These previously deemed high-risk areas within cities also relate to a pattern of continued segregation, as these areas are still predominantly minority neighborhoods. Redlining is not something that has been left in the past. While illegal under the Fair Housing Act, it still occurs throughout the United States. Coming soon, we will have a discussion with John Relman from the law firm Relman Colfax. Relman Colfax is on the forefront of the fight against contemporary redlining. We will learn more about what modern redlining looks like and what firms like Relman Colfax are doing to help address this problem. Until then, stay tuned for more from the Unfair Housing team as we delve into topics including contract buying, white flight, and eminent domain. We'll see you back here next time.